All right, good morning, everyone. Welcome to IAD's fourth webinar on the series, five series of webinars, and this one is on infinite banking. Which I'm pretty sure everyone, and if you're on Facebook, on any type of social media, you're seeing folks talk about infinite banking. So here today, we have Mark Clayton with Mutual Trust, and he is actually a genius when it comes to infinite banking process. And Mark, here, take it away, my friend.
Good. Well, Bernard, thank you so much for having me. I'm excited to talk about one of the subjects I'm most passionate on, aside from life insurance. What an amazing tool it is. And now more than ever, life insurance should be something that you're discussing with your clients. It's far more than what it used to be. And it was important back then. It was death benefit to protect your family in case something bad happened. But we don't talk about life insurance anymore. Not so much anymore like that. We talk about the living benefits. And it's not just the living benefits of the death benefit, it's how that can be used to benefit your family in times of struggle and sad, difficult times. It's the living benefits that you can utilize because you own a life insurance policy. So what we want to share today is a story about one of the concepts. It's one that we as a carrier, Mutual Trust, have been promoting, utilizing, supporting, and just really embracing the sales that we see out of that and helping our agency partners like you, agents like you out in the field, understand where the market is, how to attract those clients, how to identify the clients, how to have the conversations, and how to create some revenue or change your practice altogether. So with that, give me 1 second. We're going to do the technical piece of this where I share a screen. All right. So what we're going to talk about today is infinite banking concept. Probably refer to it to save time and words. I'll just refer to it as IBC. Infinite banking concept is nothing new. It's actually been around a very, very long time, but it became popular a little while ago. And really how IBC can be utilized to create tax-free generational wealth for your client and then their future generations. My name is Mark Clayton. I'm Regional Vice President with Mutual Trust. I've been with the company 18 years. The only reason I'm going to tell you any of this, because nobody needs to know my biography, but it comes with a little bit of history. In the 18 years I was with Mutual Trust, shortly after I started, we were the right carrier at the right time, and IBC came to us. And like anybody in sales, when you start getting sales, you like it, and then you start thinking about it, going, I wonder why we're getting this. It just so happened we had great products, and it starts with the product. The product has to work for the concept, and we've got that. Also came with the willingness to embrace this concept. And as we get through this, I'll talk a little bit more about why that's important, where it's important, and why we are one of the premier IBC carriers out there. Compliance says hi. I don't have any illustrations today, so we don't need to worry about that. But you are prohibited from giving tax or legal advice unless you're licensed and knowledgeable enough to do so. Dividends are never guaranteed. Policy and rider provisions have all the details about anything I'm going to talk about, and that's that. So I thank you for taking time out of your schedule. You're not meeting with clients, so you're sitting down watching a computer screen. Hopefully, we've got you engaged and you're looking for something. And what I hope to give you is something that you can use. So please, take notes, ask questions, write down some names. I'm not going to make you an expert in the time we spend here talking about this, but what I hope I can do is I hope you acknowledge that this is a concept, or maybe you've even heard about it, so you know it's real. But you understand that this is something that's out there, that's viable, and there's an opportunity for you. And two, you're going to recognize the kinds of clients that this most attracted to the concept. And lastly, and most importantly, because we won't make you an expert today, that you're going to know who to pick up the phone and call when you get to the end and have written some client names down. We're going to talk about infinite banking concept. I'm going to give you a little bit of introduction and a history. We're going to talk about the client profile because that's important. Who are we going to talk to? We're going to talk about the solution, how it works, what it addresses, because any solution is a great solution, but when you can tie the solution into a problem, that helps you identify the clients who are going to benefit from this, and it's going to help you close those sales. We're going to talk about the benefits of IBC from a client perspective. Of course, the benefits for you are increased revenue source or a different track to run on, something different to do. We bribe you at the end always. So we'll start with an introduction, and I'll ask the question, what does J.C. Penney, Walt Disney, Ray Kroc, and Doris Christopher have in common? This is a rhetorical question you don't have to answer out loud. And if you don't know who Doris Christopher is, shame on you. She's a creator of one of the finest companies, Pampered Chef. All these individuals were proprietors. All these individuals had various troubles with their business at points in time, either starting it in the case of Doris Christopher, Walt Disney, expanding it in the case of Ray Kroc, or keeping it afloat during the Great Depression in the case of J.C. Penney. But all of them had permanent life insurance. And because way back when the only thing that existed was whole life, we know for certain it was whole life. Although Doris Christopher's a little newer, but I do believe hers was whole life. They all used their whole life cash values to help finance their business needs, whether it was starting, building, or keeping it afloat. So this isn't a new concept. This isn't anything that just started. What's happened is this has become popular. Popular because of things that are going around in the economy and have been going on for years. It's popular because the trajectory of a potential retirement has changed. Our parents all got a job, stayed at the job, got a pension, retired. Used the pension, used Social Security, they were set. Well, we live in a do-it-yourself society now. Nobody stays in a job. Pensions don't really exist for the great majority of us. So we've got to figure out how to retire ourselves. And if I may quote Robert Kiyosaki, it's not how much money you make, it's how much you keep and how hard it works for you. And that is the essence of the infinite banking concept, is getting your money to work harder for you. So now we're going to get with the boring part. I am going to define infinite banking like the dictionary explanation. This is out of Nelson Nash's Becoming Your Own Baker book. Nelson Nash was an individual, wore a lot of hats in his lifetime. One of the things he did was wrote a book to popularize this. And that's really where I think the concept started to take off about 25, 30 years ago. He put these thoughts in a book, conceptualized it for clients, for agents to discuss with their clients. But again, as we saw, I haven't said this yet, whole life has been around 200 years. And one of the functions of whole life has always been you have cash value that's available to you. So the concept's not new. Whole life companies have been doing policy loans for years and years and years and years. What's become popular is learning how to talk about it, learning how to educate clients. Big banks within the US, they own billions of dollars of whole life insurance. Rich people own billions of dollars of whole life insurance. And there's a reason why. Nelson Nash's book brought it to the common folk, the everyday Joes and Janes out there who are looking for a better way to do this. In his book, Nelson Nash defines infinite banking as a financial principle based on US tax laws and insurance contractual guarantees. If I just lost you, I want you to wake up, because that is an extremely important statement. When you start learning about a new concept, you go out to the Google machine, you Google this later, and I encourage you to do that. But when you Google it, you see this and you're like, this is too good to be true. But let's take a look at that statement right there, because that says right clearly, it's not too good to be true. It's a financial principle. We'll get to the principle part and how it's used, based on US tax laws. US tax laws concerning the benefits of permanent life insurance. If you structure a policy correctly, the IRS considers it insurance and doesn't tax gains or penalize gains if accessed. Just got to be it can't be a modified endowment contract. It can't be something we're just loading up with cash with no regard to the death benefit. We've got to have the death benefit. And then we've got all the access to what we put in and all the access to the growth in it too. It's also based on insurance contractual guarantees. And this is where the whole life part of it comes in. I often get asked, can IBC be done with other products? Technically, yes. Is it right? I don't think so, for a variety of reasons. And number one is the insurance contractual guarantees. When your client, if you've ever sold the whole life policy, what you were holding in your hand at delivery time was a contract. It states, if the client does this, they will have that. There is nothing my company, Mutual Trust, or any other whole life company can do about a contract that's been issued, provided the client pays the premium. If they pay the premium, I've got 2 policies. I can pull out my policies right now and I can tell you without hesitation, you give me a year, 2028, I'll tell you how much cash value my policy is guaranteed to have. Can't change. No matter what happens in this environment, Mutual Trust can't change what my policy is going to do. We bear the risk. Now, we do so very responsibly. We do so very smartly. Whole life companies have been around basically all of them have been around more than 100 years. We've gotten good at this. We know how to price our products. We know how to invest our money to support those products to make sure that we can meet those obligations for our clients. So this statement wraps all of it up in one. You want a foundation for a retirement. You want something rock solid you can count on. You want something that you're going to be used to do everything else. IBC becomes the foundation that will make the rest of what you do in your financial portfolio work. It's a financial principle based on U.S. tax laws and insurance contractual guarantees. When I buy this, when I do this, I know exactly what it's going to be. So again, the most boring explanation ever, but one I am extremely passionate about. So more conceptually, let's talk about our clients. Infinite banking is simply the idea of creating capital for your clients, capital that your clients can use. We've all heard capital is king, right? Access to capital is the key to financial prosperity. When we don't have capital, what happens? We've got to lean on credit cards. We have to go without. We can't fix our house and it goes in disarray and it starts a cycle of, a downward cycle that becomes harder to get out of. So capital is important and we must create it. Think back to your days when you first learning, I'd say you learned this in school, but our educational system does a bad job of teaching true economic thought that we can all take and utilize in our everyday life. But I do remember hearing myself that one of the first things you need to do is you need to set aside your safe money. What's your very first safe money? That's the one that protects you in case you lose your job. You need 6 months savings set aside. Okay, that's great. I agree 100%. The problem is America doesn't do that. We need to. But if they do, if they've done it, where do they keep their capital? If a client has capital, if a business owner has capital, where do they keep it? By definition, or I guess not by definition, but most likely it's going to be somewhere safe. That means it's going to be in a bank. And it's sitting in a checking account, it's sitting in a savings account. Maybe they're hedging their bets and getting a 10th point more interest by putting it in a money market account, but it's somewhere where they can access it. It's not exposed to risk. Capital is never exposed to risk. Okay. Is it liquid enough? Of course it has to be. That's why it's sitting in those accounts. Is it taxable? Of course it's going to be. I guess now they might be getting a little bit of interest. I hear interest rates are going up. But for the most part, there's not a lot of growth in it. And that any growth they have is taxable. Is it leveraged? What does that money do? It sits there. It holds the spot. It's leveraged by the bank. They're utilizing it, but it's not leveraged for the client. Lastly, will it still grow if they use it? If you go to the bank and take out your money, what does it do? Nothing, it's gone. It's doing whatever you used it to do, but that original account has been depleted. Where does access to capital, or we've discussed infinite banking and banking. What do they offer the clients? Well, we think of this in terms of what is the biggest financial problem that all of our clients face. And depending on where your client is at that point in their life, they may be getting ready. They just, it's graduation season. Their son or daughter just graduated high school. Now they're getting ready to go off to college, and college is so expensive. Who knows what kind of plan they've got for financial aid, but now they may be thinking, oh my gosh, all right, we're here. How are we going to pay this for the next 4 years? You may have a younger family who's getting ready to buy their first house. So, relative to their point in time in life, their problems are all different. But ultimately, everybody shares what probably is the biggest consideration, and that is, how am I going to retire? If you walk down the street and ask anybody, are you 100% sure your retirement, or you have doubts? Any honest individual is likely going to say, I have doubts. If they don't, congratulations, they've worked very hard. Tying that into Robert Kiyosaki's quote about it's not how much you make, how much you keep, and how hard it works for you. I've been presented opportunities throughout my life from different ideas or strategies or things, and ultimately it comes to, this will work for you. All right, it looks like it'll work for me. Okay, all you got to do is write me a check. Well, that's fine and dandy. I can write you a check, just don't do anything with it, because I'm spending my income too much. It's going everywhere else. What I needed to do was figure out how to stop spending so much. If we take a look at the average American, where do they spend their money? We spend it in the usual places. We have to have cars to get around. We're paying for housing. We're paying for living expenses. And there's interest payments on top of that for many of those things. Mortgages, car loans, credit cards, all of those are dollars we're giving away to somebody else. What does that leave us? 34.5% of every dollar is spent on interest. I make $1, I'm only working with 65.5 cents. Well, that seems like I got a bit of a hurdle to overcome. The average American, and depicted here graciously, saves about 5%. Real number, I haven't seen the number in the last year or two, but I would guess the real number is lower. And if you take a look at where we are today with inflation starting to creep up, where gas now costs, what did I hear in California? Somebody spent over $8 for a gallon of gas. I left on a trip for the holiday weekend, and on the way back, I saw gas prices spike by about 40 cents locally. Where does this stop? We don't know. Where's the first thing? What's the first thing that's going to happen? Well, those savings isn't going to happen for a little bit. When we think about how we spend, we need to focus on volume of interest. What we're taught all along is pay attention to the APR. What's your annual percentage rate? I've got 12. Oh, you're lucky. I got 14. I've got a mortgage at 3.25. Oh, I wish I would have acted fast. I got 3.75. They're comparing interest rates, but what they lose perspective of is, what does that represent? What does that number represent? So let's just take a look at this average American family with a car, credit cards, and a mortgage. Some of these numbers are a little high. Some of them are accurate. Some of them are low. It's an age-old shot from Nelson Nash's presentation. Make your mental adjustments if you don't like the rates I used. It's the volume of interest, not annual percentage rate, that depletes our wealth. So let's look at this chart. If we finance a car at 7% for $30,000, yeah, I know you can probably get it cheaper. That's fine. But that gives you a car payment of $594. Of that first car payment, how much of that $594 is interest? $175. How much of your payment, how much of that $594 is actually going to reduce your debt? Only 70% of that payment. 30% of it is going to the place that helped you finance your car. What are they doing with it? Oh, they're increasing their wealth. They're increasing their stockholders' wealth or their private wealth, wherever you bought it from or wherever you borrowed from. They're using that 30% payment to go make more loans. go make more money off of what you've done. So out of the 594, only 419 reduced your debt. If we take a look at a credit card, and this seems fair, 12%, that's pretty nice. Run of the mill. We know they exist in the 26%. We know you can get some better ones. But your typical family's got a revolving credit line. They're not paying off their debt all the time. And you know, if they are, they're going to be able to keep doing that. But that $10,000 payment, got a payment at 250. They feel good. They're exceeding their minimum. They're chipping away at this little by little. The interest cost on that is $100, or 40% of what they've just paid goes to create wealth for somebody else, leaving $150 to reduce their debit balance, credit balance. How long will it take them to get out of debt? Kind of forever. A mortgage, 6%. It's gonna, about a year and a half ago, that was almost twice what you can get. Now it's not so high. But if we look at financing a $200,000 house, which tell me where those are, I don't think they exist anymore. If we finance a $200,000 house, 30-year fixed rate, we got a $1,200 payment. Interest cost on that is $1,000. That's 83% of your payment is going to create wealth for somebody else, leaving $199 to reduce your debt. Going to take you forever. Now, yes, the car, the mortgage, we get it. There's an amortization schedule. You're talking about the first payment. In a car, that's absolutely true. By the end of the car payment, that's going to be way flipped. $560 is going to be going to reduce the balance of the car. But don't worry, the lender got their money. They took all their interest up front. But the mortgage, how many people do you know in the 28th year of a 30-year mortgage? It takes a while to get there, because when we buy our first house, it's the house we can afford. But then we do things. Our career grows. We get better. Our income increases. Well, now we want to live somewhere nicer. Now maybe we've just added kids, and now we need a bigger place because, well, we've got a bigger family, and oh my gosh, all the toys that we have, we need more space. Oh, now Junior's getting ready to go to school. Now we got to be in a place that has good schools at our disposal, because we want our child to have a good education. Our income has grown, and now, we're keeping up with the Joneses, because that's what we do as a society. And now we're moving again. What happened every time? Oh, I refinanced. Yes, I'm getting a mortgage, but guess what I'm doing? I'm also restarting that amortization clock. Back to the beginning, majority of my payment is going towards debt maintenance. Add those up, that's $1,275. That's $15,000 a year, and over 20 years, that's $300,000. So Robert Kiyosaki said, it's not what I make, because, well, great, I can retire, I just need to make more. Fine in concept. Most people don't have that ability to just walk into their boss and say, hey, you know what, I'd really like to retire. Give me 20,000 more a year so I can start planning for my retirement. And if your client could, their boss would give it to them, and the boss gave it to them. Guess what they do? They just start spending that 20,000. I've got 20,000 more. My lifestyle just got better. But if we focus on what we're spending and make a commitment to growing our own wealth, instead of giving somebody 15,000 a year, 300,000 over time, we can keep that ourselves. That's 306,000 without doing anything with it. What if we can grow that? No matter what you do, when you buy something, you finance it. We either pay interest to lease or finance what we purchase, or we spend cash and lose interest income that can continue to grow because we use the money. Quick example here, and to pick on somebody, I apologize in advance. The Dave Ramsey and Susie Ormans of the world say debt's bad. That's a true statement. Not all debt's bad, though. Understanding how to use debt, how to control debt, how to make debt work for us is a key. They say pay cash for everything. Well, that's great. I've got a cousin who they'd be so very proud of. When she was 16 years old, she wanted a car. Her dad, my uncle, told her, get a job, save money, buy the car. And so she got a job. She worked very hard, saved almost everything she made. Her dad was really impressed with her, and helped her buy the car because it was a specific car. an orange Camaro. I don't know why the orange matters, but it's part of the story. So she got her orange Camaro. It was her dream car. She was so happy. She paid her dad back because she had to. That was part of the condition. From that point forward, she continued to work. She continued to work hard. She continued to be a good saver. And she would accumulate cash and she would go buy another car when it was time to buy another car. She would use her cash and then save. When it's time to buy another car, go grab her cash and go buy a car. Again, Dave Ramsey, Susie Orman are so proud of her because she's never financed a car, except she missed out. They'd say, congratulations, Sue, you never had a car payment. But no, she did. She had a car payment every day of her life. She had a car payment before she bought her first car. That car payment was a contribution to savings so that she could afford to buy the car. When she bought the car, she spent her cash down. The only way she's going to get another car without borrowing from somebody else is she's going to have to save it. So she would make deposits into her savings account. Was it at her own desire? Absolutely. If she needed to skip a month, she could. She could double up next month. She could reduce them. She could do whatever she wants. But the value of the account was just the value of what she put in. The problem with this strategy is, what do we as Americans do? We're lazy. We say, well, I just borrowed 20,000. I'm going to take the next 3 years to put that 20,000 back. So 20,000 divided by 36 is a number. And I use bad numbers where I don't even know what the math is on that. But let's say it's a little over 500 a month. So I'm going to put 500 a month in. At the end of 3 years, guess what I have? I have 20,000. Well, what did I give up? I gave up all the growth that would have occurred. What my payment needs to take into consideration is what that would have grown to. We talked about the problem of getting retirement. We talked about the problem we all have getting retirement is we don't have the cash flow to do it. We're spending it all somewhere else. So we've got to focus. How do we do what we can do to keep more of what we make and make it work for us? So we tie into life insurance. Again, 30 years ago, life insurance was marketed specifically as an income replacement. What is your human life value? How much do you make? How old are you? We project you to live this long, so this is your multiple. Use that, buy that death benefit, your family's set. But there's a greater need, and that greater need is access to capital for financing. Again, financing, traditional finance, we have to ask somebody for the money. We have to prove to them we don't need it. And once they agree to give it to us, we are subject to their terms. Do you want to be subject to various types of loans right now in an inflationary, recessionary period? Maybe not. What flexibility do you have? Nelson Nash created this concept sort of in a sweat laying in bed one night when prime rate was 21.5. And because he was a good customer, because his bank liked him so much, they lent him money at 23.5%. And he had that money, he used that money to purchase some land, real estate investment. Interest rates started creeping up. That loan interest got to 23.5%. That's a strain on the pocketbook, to say the least. Obvious answer is, well, sell the land, get out from under this. Who's buying land when it's 23.5%? So the economy was keeping them up at night. Had to find a way out. The thing he did was he owned a life insurance policy, and he realized he had access to the cash value in the life insurance policy, and he could use it. What he created was an opportunity. What he created was a source of capital. Again, he didn't create the source of capital. He had been doing that all along. What he understood is he had a source of capital that gave him power of choice. Power of choice, when to use it, when not to, when it's at his advantage and when it isn't. When your only choice is to go hat in hand and asking a lender for a loan, you have no choice. Your choice is to accept their terms or don't get the money. If you've got capital at your disposal, you've got choice. And when you choose to use that capital, it's subject to your terms. You determine how to use it. Nelson Nash utilized the cash value in his policies to relieve that financial pressure he was feeling from those real estate holdings he was having that was costing him an arm and a leg in increasing interest. He borrowed, took the pressure off. When everything got back better, he was able to sell the properties, recoup his money, replenish the loans from his whole life policy. Everything worked out just fine. And because it's subject to your terms, it's flexible. It's flexible in how it's designed. It's flexible in how it's funded. It's flexible in how it's used. Let's get to the clients. Who are the types of individuals who this would attract? Quite honestly, I think the answer is it should attract everybody. And I was once asked by an agent who was in tears, young agent, we were coming back from a conference and we are talking about IBC on the plane the whole way. And she was in a tough time, going through divorce, had a little one. And she was scraping and clawing and scratching her way in. She had $100 a month she was putting into her IBC policy. And she called me the very next day after we got home from travels in tears, and asked me, am I doing this right? I said, what do you mean? Should I be doing more? I said, do you have more that you could do? She said, no, I'm strapped right now. It's hard being a single mom going through the divorce. I'm like, no, then you're doing everything perfect. When you, there's a saying, and I coined this, if anybody wants to use it, please do. If you, oh gosh, I'm going to date myself also, because I don't even know if they're around anymore. There was a bike they used to make called Schwinn's. They were the biggest. They were the best. Everybody in my neighborhood as a kid had it, wanted a Schwinn. If you put Schwinn money in a policy, you're going to be able to buy a Schwinn bike with it. If you put Porsche money into a policy, you're going to be able to buy Porsches with it. There's not a problem with it, because one individual who can afford Porsche money has Porsche needs. The individual who can put Schwinn money has Schwinn needs. There's a perspective on that. But the types of clients that most resonate, the ones you can go out to today: one, small business owners. Mr. Business Owner, Mrs. Business Owner, may I sit down with you for a minute and show you a way to increase your cash flows? Doctors, dentists, other professionals, individuals who excel at their profession, but they're not necessarily good business people. Doctors, dentists, they're subject to, I'll get into this later, but they're subject to things where additional protection is going to help them. Millennials. Surprisingly, millennials have seen what's happened to their parents. They remember 2008. It's becoming all too familiar right now. They know that they have to take things into their own hands. They generally don't trust banks, generally don't trust Wall Street, and they're doing it themselves. And yes, the millennial generation is the Google generation. They'll go out and figure out how to do it themselves. But fact state, they still need you. They need the professional to help them do this. They can learn enough to know what they want. They need help doing it though. Any clients wishing to eliminate debt, and I'm going to bring up something here in a second. Many people, my wife is a prime one. She doesn't want any debt, wants the mortgage paid off tomorrow. And nothing would make her happier, being out from obligations. Clients seeking liquidity, use and control of their money. Hey, I've got this money over here. I don't like having it here because I can use it to do whatever I want. It makes me feel good. Those are perfect candidates because we can show you how to leverage that money. Clients looking for safe asset alternatives. Whole life insurance is the best safe asset class product there is on the market because it does more than one thing. We are talking about life insurance, so your clients have to be insurable, and they don't have to have a desire to protect the family, but it's awfully nice if you're working with a client who realizes that a death benefit might protect somebody. But when they understand that death benefit is part of it, it takes some of the objections away. Another one I have here is investors. Now, the first time you show this to an investor, they're gonna want to know, they're gonna stop listening to you, and immediately they're gonna scan through pages and they're looking for an internal rate of return. What's the IRR? How much are you gonna make on this? They're knuckleheads. They need to stop for a minute. You need to pause them, and you can say, this isn't about a rate of return. It's about your opportunity money. Where is your opportunity money, Mr. Investor? And they're gonna say, well, it's an investment. No, it's not. That's an investment money. Opportunity money is sitting on the sidelines till you find your opportunity. Then you utilize it to go cash in on a bigger potential return. Oh, by the way, those all come with risk. Mr. Investor, Mr. or Mrs. Investor, I can show you a way to leverage that money where you've got all the access and control over you still, as you still do, but it's going to do more for you than that. Let me show you how to way to do infinite banking, where when that opportunity comes, you have access to the capital in your policy, you go buy into the investment. I was just working with an agent and they're showing a client how they're going to borrow $500,000 out of their policy. Yeah, that's been around a while. It wasn't that big of a premium, but it's been around a while. The agent knew nothing about IBC. Clients brought it to him and say, hey, I can borrow this money out of my policy. How is this going to work? They're making an investment. They're nearing retirement ages and they want some cash flow. And what they're going to do is borrow $500,000 out of the policy, go buy the rental property. They're going to rent it out. They presume they're going to get about $3,000 a month in investment in rental income, and that's actually on the conservative side. If they get $3,000 in rental income, they're going to apply that all to the loan from the policy, and at a specific time when that policy loan's paid off, they've got $3,000 of income where they can either use it to live on or use it to continue to fund and build that retirement plan. Where do these clients have this money that they're going to use for these plans? Well, it's going to be in a number of places. One might be sitting in a bank somewhere safe in a checking, savings, CD, maybe sitting in a money market account. We may have to work with your clients to identify areas where we can instill some spending efficiencies. For example, take a look at the client's P&C coverage. Is there something they can do to lower what they're paying for property and casualty coverage? We need it. It protects us, but is there something they can do? Are they well capitalized? Do they have the money set aside where they can deal with an increased deductible in favor of spending less for their coverage? Are there other things that they could be doing? Maybe they're overpaying on their mortgage. Well, let's look at that money. Is there something we can do differently today that will give you something better? When you pay down your mortgage too fast, you're tying all your money up in equity, and that's great, makes you feel good. Yeah, that won't grow any faster. Yeah, equity in your house is your equity in the house. It's subject to the market. And the best part is when you want to use the money in your house that you use to pay off your house, you have to ask somebody for it. Is that necessarily best? Maybe, maybe not. And maybe cash. Maybe it's a windfall for a business owner. Maybe it's cash sitting in the corporate accounts. I'm going to pause for a second here. And this is a strategy that I can attest has been the most efficient way to introduce IBC into your practice and converse with clients. The big picture system is a system that utilizes whole life insurance with a targeted approach to talk to people about how to get out of debt. Utilizing the guaranteed cash values, we can show your clients, hey, listen, this is great. This is what you're doing. I applaud your efforts. You have a great credit score, but it's going to take you 30 years to get out of debt. Do you know that? We can show you how to get out of debt faster. This is a system that is promoted and available to anybody affiliated with Mutual Trust. And it's a software. You run an illustration, you put it in, you get the information from the client. The software spits out a roadmap, a picture, a ledger that you show your client that you can get out of debt. If you're interested in this, I can attest to you this system works. One, it's promoted by our biggest agency. And they've been our number one agency 9 of the last 10 years. The 1 year they weren't, they still grow, but somebody had a little bit better year. It works with agents who don't know how to spell whole life insurance. In fact, I took a peek and I do know that there's an individual on the call who knows an agency all too well that we had been working with at Mutual Trust, trying to introduce whole life to their agency. And I don't think they ever sold a single policy. Maybe we got a term out of them, but never single whole life policy. They started utilizing this strategy within their ranking core, and they found it was the greatest system to recruit to. And the success it brought is unbelievable. And it's not just them. I can talk to another agency that used it to show their agents, hey, you want to recruit? You want to just not build your own business, but you want to build the business underneath you. Here's how. I've seen agents who don't know the life insurance jump in and create life insurance revenue for them. If you're a Medicare agent, what are you doing during the other 9 months of the season? Do you want to have something where you can talk to them? You want to talk to your Medicare families about helping their kids get out of debt and stay out of debt? Maybe this is for you. But the opportunity is real. We've put it through our compliance team. Everything works. All the clients got to do is follow the plan, and you're going to help them get out of debt. And there's no greater feeling than giving people that security. Answering that question, how am I going to retire? What does the plan look like? That process is also great for small businesses too. If you're interested in that, again, totally up to you. It's something you can take a look at. We do webinars to kind of help educate you on the opportunity and what that looks like. Contact Bernard and we'll work together to get you that information. Mentioned before, can this be done with other products? Well, kind of, sort of. But whole life is the infinite banking answer. One, guarantees provide certainty. It becomes the foundation that's going to make the rest of what you do in your financial plan work. The first thing we have to do is, when we're building a house, is have a foundation. If you don't have a foundation, the walls crumble, right? It's not going to work. Land's going to shift, things are going to fall. You don't have a house anymore. We've got to have a foundation. IBC Whole Life is your best foundation. Whole Life gives you liquidity, use, and control of your money. That's our mantra at Mutual Trust. Mutual Trust is a company that offers participating whole life policies from a mutual company. What does all that mean? Mutual means that we're not owned by stockholders. We don't cater to the whims of the market. We don't sweat out quarterly market analysis. And what's that going to do to our stock price? We don't have stock. Well, we have one share of stock held by our holding company. Not for sale. Nobody can get to it. We are a mutual company. We exist for the benefit of our policy holders first and foremost. You go to a stock company, where do you rank as an agent? Where do you rank as a client? You're nowhere near the top of the list. They need to answer to the stockholders first. That's who matters. We need to make sure that their profit, that their investment in their company is paying dividends to them. We like paying dividends too, but because we're owned by policyholders, our profits are paid as dividends to our policyholders. That's what participating is. They participate in the guarantees of the company. We keep a small share to make our business better, do things more efficiently, grow our business, do the things we need to, but the majority of profits go back to our policyholders, the people who own us. And because they're owners of the company, they have first right of refusal to their policy. They have the ability to take money out tax-free with no penalties. Cash value does that. Liquidity, use, and control. What do we say at Mutual Trust? Hey, if you have cash value, you can get it out 10 days after you created it. No questions asked. Guarantees, important in the plan. I want to know if I'm a business owner and I'm planning to expand my business in 5 years, and I come to you and say, all right, help me do this. 5 years, I'm going to need this amount of money to do it. All right, here's my plan. I can see on a ledger. Oh yeah, look at that. I'm going to have it. All I got to do is get there. Flexibility. Those other individuals I mentioned before. Whole Life has a bad reputation for being an inflexible product. Oh, that agent sold you Whole Life because they wanted to make a lot of commissions, and you're going to have to pay premiums to the day you die, probably 5 years after that too, because yeah, no, that's a bad product. They don't understand Whole Life. One, guaranteed cash values means there's more flexibility in a whole life policy than any other policy there is. In a policy that has no guaranteed cash value, where it goes down, where yes, hey, this is guaranteed to blow up in 20 years, you don't have any flexibility. In 20 years, you don't have anything you can do except continue to pay a lot of premium because now you're 20 years older and it's getting expensive. But guaranteed cash value gives you the knowledge that you can do whatever you want. Flexibility, it's flexibility in design because this isn't the policy that Nelson Nash even bought. It isn't the policy that your grandparents bought. This is a flexible policy. We minimize the death benefit. We maximize the cash value in the way we construct it to give true flexibility. When we utilize our cash, there's no interruption of compound growth. What do I mean? Hey, I've got capital. I've been talking the whole time about using that capital. When I use it, it's still there. My policy is collateral for a loan from the insurance company. So my policy is going to grow per the guaranteed contractual conditions in that policy. Nothing can change that. And I can even prove it in illustration. Our gains, they're going to happen and they're tax deferred. And if I do everything right as a client, I'm never going to have to pay taxes or possible penalty if I do something before 59 and a half. It's my money because it's life insurance and the IRS likes life insurance. Liquidity, access, and control. I'm repeating myself because that's important. When your client wants to access the cash value, they have the ability to do that. They can get all of their cash value. They have access to all of it, less interest charge on that. The access is easy. It's a form. We use forms. We're old school, but it's about protecting our client's interest. There's bad actors out there. We want to make sure that only your client is getting only their cash value. Nobody else does. They have control. And of course, life insurance. I take something, I help a client get into a plan. Life happens. We all know stories. I'm 56 now. I'm faced with the reality that I look around the news and I hear a celebrity, an athlete, somebody I've known dies, and they're 56. Oh, they're 55. Oh, they're 57. Life happens. You help with an individual, you start the plan. The first thing you do for them is take, hey, this $10,000 that you're going to put in this money market account that you're saving. Hey, that's great, but we can show you something better. We're going to take that 10,000 and oops, I just created a $500,000 benefit for you. Is that something the family would like to hear from? Why participating whole life? One, it's not what you think. We can custom design the plan. We've got flexibility in design. You need something focused on death benefit, little but cash value. Yeah, we can do that. You want something that doesn't focus on death benefit at all and gives a lot of flexibility in how much money is going to PUH. We can do that. We've got competitive returns. Our guarantees are some of the best out there in the industry. It's who we've always been. The benefits of these policies, they're flexible funds. They're collateral. You've got the cash value, you use it how you want to. I mentioned the doctors and dentists, they got some other issues. One is threat of lawsuit. There's privacy and asset protection. It varies by state, so do consult with your state's DOI, Department of Insurance, to understand what protection they will have. But money inside of a whole life policy is not subject to lawsuit for these individuals. We've got tax advantages. They can be used in a business plan in certain ways to give an advantage to the client. IBC is a way to create a financial legacy. How do rich people stay rich? They're passing on a lot of wealth. And one of the ways they do that is a tax-free death benefit. I like to think of this infinite banking concept. I think the word infinite can be applied in two different ways. One, infinite in the number of different ways it can be used. I've got capital. If I asked you all to start listing off the ways you use capital, it's going to be a long list and we won't ever get out of here. It's also infinite, though, in terms of a legacy. My policies, my IBC policies are going to create a death benefit that will ensure my wife is taken care of. But I have more than I need because I want to give some to all our kids. It's part of our plan. Life is hard. We lived it. We grew it. We're blessed now. I want to, at some point when I can't be here to do it anymore, ensure that they've got something that makes their life a little bit easier. There's also additional protections, the true living benefits. For that individual who wants to do it themselves, that's great. What happens if you become disabled? What you're doing is going to stop because you're not making the money anymore. Something's got to end. That's going to end. What if I can show you how to way to protect, give you insurance for your bank plan? We can do that. So next steps. At the beginning of this call, told you I'd not make you an expert, and I know I didn't accomplish that. But we had three goals. One, do you know this concept works? If you don't know, if what I talked about doesn't resonate, after we get off this call, go to Google, type in infinite banking concept, type in become your own bank, be your own bank, put it in there. When you see the amount of material access links that come up, now stop. Trust that I'm right. It's out there. Now, know that clients are out there knowing it. And if you don't know what IBC is, you're going to have no way to help that client when they come to you. When you meet that individual who says, hey, do you know anything about this infinite banking concept? I saw a link. I saw it on, oh, I'm old. I don't know what all social media sites are, but one of them. I saw it on TikTok. I didn't even know it was on TikTok, but I guess it's on TikTok now. But I know it's on YouTube, and they're finding it, and they're calling us saying, hey, you do infinite banking. I want a policy, and I'm giving it to agents. Be one of the agents I called to give it to. Do you have those clients? Who have you talked to? Who are you going to talk to? Are they looking for a better way? Is this something that can benefit them? Are they a business owner? We can tie in buy sell, we can tie in key man, we can tie in other solutions to give them further benefits and access to that capital to make things work better. If you know that it works and you know who you want to talk to, first step, get contracted. Contact Bernard and the team. Let them know you want to get contract with Mutual Trust. Let's get that process started. Second, start having that conversation. Talk about your opportunity with your client. Who are they? What do they have? Where do you see this fits? We'd love nothing more to help you try it once, because once you try it, you're going to see it's pretty easy. By the way, the best marketing piece, people ask me all the time if I have marketing pieces. Yep, I've got a lot. I've got an infinite number of marketing pieces. Best one is a policy on yourself. Best thing you can do is say, hey, listen, this is what I'm doing for myself. This is how I'm making it work. Yeah, you know, when I built that edition, yeah, that was my policy that helped me do that. You did what? I want to know more about this. Bernard, I want to see if we have any questions. In closing, I'm just going to leave the screen up that talks about Ireland. We love our trips. We love celebrating agents that do a tremendous amount of work for their clients, how they change their lives in different ways. We want to celebrate with you. So get contracted. Let's start doing IBC. Joe asks a question. Can we speak to the cash values of mutual trust? I mean, is the policy structure with high early cash values, and what interest rate does the loan occur? Yes, absolutely. There is flexibility in design. I can create a policy that puts over 90% of the premium into paid up addition riders. Paid up addition riders is like excess premium if you're more familiar with the universal life world. Paid up additions are what creates immediate cash value that the client can utilize. I can construct a policy that complies with the IRS's MEC rules that has that much premium going to the PUAs. There's a rule in the life insurance industry, though. The more cash value a client has in year one, the less the commissions are. So it's not a sale that we see routinely. It's usually best fit for certain scenarios. We normally see things that are structured with 30 to 40% of the premium going towards the insurance cost, the part that makes the IRS happy. The rest is going to paid up additions. Do we have flexibility to move that around? Absolutely. One of my IBC policies, and I'm not doing it wrong, so if anybody wants to challenge me, call me up. I've got 70% of my premium going to insurance costs, 30% to PUAs. I wanted more permanent death benefit as part of my plan. I've got the ability to fund it higher, but I'm not right now. It's more death benefit than not. In years, it will operate just as efficiently. But yes, all that flexibility does exist. Great question. Thank you, Joe.
Here, Mark, we have one more question. And it says non-direct recognition loans.
Yes.
As a question.
Here's your 5-second answer. We are direct recognition and it doesn't matter. And when you want further explanation on why it doesn't matter, the first thing I'm going to ask you to do is explain what you think direct or non-direct recognition is. If you understand it correctly, then I will go into further detail. Each of them has an advantage and it's different ways of doing it, but insurance companies work the same. The interest, the lost investment income that comes from policy loans is spread out through dividends. No matter what you think, it's how your carrier is spreading them out that you want to understand. Loan interest 5%, or does it differ? Our current loan interest rate is 3.85%. 3.85% on the product we utilize for infinite banking. However, infinite banking can be done with any policy. We do have a different policy. It's got a slightly higher interest rate, guaranteed interest rate, non-forfeiture rate. Also has a slightly higher loan rate. I was thinking I didn't want to say this, but I'm going to say it because I'm excited. I was the IBC point person for 18 years, and over the course of my time, I've seen interest rates mostly fall, but there was a little blip in there 12 years ago. Interest rates went up a little bit. They went up about a point, but I saw our loan rate go from about 5.5 to over 6.5. Didn't last long. Just weird little bubble. Interest rates went 5.5, 5.75, 6.5. Pretty quick. No, that lasts a little bit. And then it started falling, and we've only had decreasing interest rates until now. I want our loan rate to be not 3.85. I think I want our loan rate to be 5. That's going to offer your best opportunities for your clients. When our loan rate was 5.5%, that sounds worse than 3.5, right? Yes, absolutely. 5.5 is a higher interest rate than 3.85. What was out there in the marketplace, though? Business owners going to banks trying to get capital were spending 8 or 10. Right now, they're not, I don't know about right now, but they weren't having to spend 8 to 10 to get capital. Capital was readily available and it was cheap. Interest rates were so stinking low. When our loan rate goes up, everybody else's rates are going to go up a little bit more. It's going to make IBC even more attractive. And it's going to make IBC even more of a thing that your clients need to have, because we don't know what's going to go out there in the marketplace. Most carriers offer a variable loan rate, and it's tied to the Moody's corporate bond yield. There's a formula. When the Moody's corporate bond yield changes, our loan rates have to change. It's like I believe it's by law. Again, anybody who wants to know more about non-direct recognition loan, anything else we have, Bernard?
I see no other questions. Well, Mark, my friend, I really appreciate you. And folks, I'm going to be contacting you. So like we said, we can get you started, get you contracted. You'll have full access to insurance advisors, myself, and any questions. I know Mark will be available to take them. And if you have cases, if you have questions on cases, reach out to me, or I'll reach out to Mark, and then we can come up with a good game plan for you. So again, Mark, my friend, we really appreciate you taking your time out today, going over infinite banking with us folks. And if there isn't any other questions, I want everyone to have a good day and a good rest of your week.
All right. Take care, everybody. Thank you.